Hi, everyone. This is Jason Bjork of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest and one of my favorite guests that I like to interview every couple months for her insights. She wrote the book Broken Money, Why Our Financial System is Failing Us and How We Can Make It Better. And she's one of the top global macro experts out there. Lyn Alden, thank you for joining me again.
Thanks for having me back. Happy to be here.
So, Lyn, we're recording this interview on Tuesday, July 16th, 2024. The Bitcoin price has rallied a little bit. It's over $64,000 again. The gold price has rallied also. It's over $2,450 at $2,468 today. But I want to talk about the bond market first. Are you surprised that there's so much bond market volatility with the 10-year US Treasury yields and how the yield curve has been inverted, the twos and tens for around 2 full years, and we just had an uninversion of the 2-year and the 30-year when we're recording this interview?
So not particularly. We basically have a combination that is normally more associated with emerging markets than the US or other developed markets. And so, for example, we see a situation where we have fiscal dominance, so we have very large fiscal deficits. We still have above target, CPI measures of inflation, and yet we have a situation where, the Fed is trying to loosen policy. They spent the past couple of years tightening policy very much, and now they're in a position where they're trying to either maintain it or ideally reduce it. And we see other central banks are currently in the process of reducing it. And so the current situation is that the Fed finds themselves basically trying to, forecast potential, mild Fed cuts. We see that there are reductions in domestic CPI as well as domestic economic prints that kind of justify at least mildly reduced cuts. And so I think it's natural that they're going through that approach, even though as we look out further, that does potentially risk the seriousness of return of inflation.
So when we're recording this interview, the 10-year US Treasury yield is back down to 4.158, but it's been a roller coaster the last 12 months. It got as high as almost 5% a couple of times. I think it got to 4.7% quite a few times in the last 12 months. Do you think that if the other G7 central banks, if they're cutting rates, and if the Fed, if the 10-year US Treasury yield is falling, do you think that that is bullish for the regular stock market like the NASDAQ 100 and the S&P 500?
So not necessarily. Overall, basically, historically, the stock market actually does pretty poorly during structural rate cuts, and it's not because rates are going down, but rather it's because of external variables where the economy is diminishing, and therefore the Fed is cutting rates, and stock earnings are starting to run into problems both in terms of earnings and in terms of valuations. And so if you run into that situation, which we're already seeing, basically that by most accounts, the consumer side of the economy is beginning to weaken. So we've seen unemployment jump from 3.4% up to 4.1%. We've seen a diminishment of temporary help services and other sorts of retail driven sales, that kind of thing. To the extent that that begins happening, we see an ongoing weakness in interest rates, but that doesn't necessarily feed into earnings power, and we're already kind of maxed out in terms of equities valuation power. And so rate cuts are not necessarily the all-encompassing balm that they could be. And so I'm less bullish on the stock market and other disinflationary based assets based on cuts, and I'd be more focused on other types of assets based on cuts, things that benefit from a weaker dollar or from more currency debasement, rather than the assets that have been benefiting from the past 2 or 3 years or so.
Do you think that a lot of flight capital, and by flight capital, I mean retail investors or institutional investors in other countries have decided that on a relative basis, it's safer to put money into short-term treasury bills here in the United States for a quote-unquote risk-free interest rate above 4.5%, or to just buy what NASDAQ 100 or S&P 500? Do you think that that has driven that capital flight into the U.S. capital markets has driven a lot of the valuations, the higher multiples for a lot of stocks in the last 12 or so months?
So that's been part of it, but I wouldn't really characterize that over the past 12 months. I think that's more of a 10-year phenomenon, which is that over the past 10 years, really the US capital market has been the only game in town. I mean, almost all liquid capital around the world has gone into US markets. Other markets, they benefit from illiquid capital, so Canadian real estate, Australian real estate, Chinese real estate, and so forth, European real estate, that benefits from non-liquid, somewhat more domestic capital or Chinese capital. Whereas if you want liquid capital, that's doing well, the U.S. has been the only game in town. The U.S. Prioritizes its corporate sector more so than other sectors, is very financialized, and has the biggest, deepest capital markets. And so we've been in a kind of a rather unprecedented situation of tons of global capital, whether it's European, whether it's Chinese, whether it's the rest of the world, Japanese, elsewhere, all kind of piling into US capital in a scale that has not really been seen since the dot-com bubble, and arguably higher than that. I do think there's a risk that when we start cutting interest rates, it's not going to stimulate us very well. We're already running structural trade deficits. And so the U.S. could enter a period of, more weakness, and some of that capital could rotate elsewhere. I think it's kind of a long-term inevitability that that's going to happen. It's kind of a necessary if you want to reshore a lot of our businesses and otherwise become a more domestic, more vibrant domestic economy. But the timing is obviously more, variable. But if the timing continues as it has been, that's one of the near-term variables over the next 12 months, 24 months.
A lot of other countries actually prefer a weaker dollar, at least on the low end of the trading range for the dollar index, because then foreign governments and foreign corporations, they start to borrow more dollars. And then also, like historically with global trade, the other economies in other countries, their economies tend to do better in a weaker dollar environment rather than the dollar index, rallying above 104 to 110, 112. That's more of a margin call on the global economy.
Yeah, I think that's what we're seeing. I mean, overall, basically, most people assume that a stronger dollar is good for America and bad for other countries. It's really more mixed. I mean, there are plenty of countries that prefer having a weaker dollar so they can continue exporting. There are other countries that are very harmed by a strong dollar because they took out dollar denominated debt, and so they're very squeezed by a harder dollar. Overall, I think we can characterize the fact that the stronger dollar, if you think about, where most U.S. consumer spending comes from, a majority of it comes from the upper half of the population in terms of wealth and income. Many of them have locked in fixed mortgage rates and own stocks with locked in fixed corporate debt rates. And so if I use myself as an example, I'm not a boomer. Many of these are boomers, but I'm younger. But many of us have locked in fixed rate debts, and we have cash equivalents or money market funds. And so every time the Fed raises interest rates, we get a higher income, but our expenses don't change. So we can actually go and spend more. And then so as long as our stock prices are also doing decently because of foreign reinvestment, we really actually ironically get stimulated by higher interest rates, which is not the intended effect. And so as we enter a period where other central banks are beginning to finally loosen monetary policy, and that we're likely to see the Fed continue with that plan of loosening monetary policy, I think a key factor to focus on is that many people, boomers or younger people like myself, we locked in mortgage rates at like 3% or sometimes below, or basically 2.5 to 3.5% interest rates. And so to the extent that we get mild interest rate cuts, that does not lead us to refinance our mortgage rates or our corporate debt rates. Largely that is unaffected. Ironically, what is affected is those foreign markets, the Brazilian companies, the Colombian companies, the Vietnamese companies, whatever it may be, that took out a bunch of dollar-denominated debt. And as interest rates start to go down, some of them get eased relative to their debt burdens, and that it could cause an emerging market boom in a similar way that the 2003 to 2007 period caused a boom.
Well, we're starting to see cracks with foreign banks now in the last few months. I mean, we've had the fifth largest Japanese bank that's a market maker for collateralized loan obligations. I think, were big in the yen carry trade, but they have a lot of losses on US Treasury bonds from the Fed raising interest rates so quickly. And then there's 40 Chinese banks. These are smaller regional banks, but the People's Bank of China, their central bank, has rolled them up into larger Chinese state-owned enterprise banks to delay a crisis. So do you think then that the Fed keeping interest rates at these levels and a relatively strong dollar, that this is causing a lot of problems for foreign banks that own a lot of older US Treasury bonds and the dollar denominated debt that you just described?
So I think it's very country specific. There's always a lot of narrative around Chinese bearishness. I'm never as bearish as China on China as the bears are, and I'm never as bullish on China as the bulls are. They have way more assets than liabilities in terms of dollar terms, and so I'm not particularly concerned about them. Um, I'm more concerned about frontier markets. I mean, I just got back from, living in Egypt for a month. I go there every year. I live part of the year, 1 to 3 months every year in Egypt. They're the type of market that has been more impacted by a stronger dollar because they're more a structural debtor nation. Whereas creditor nations like China have a lot more tools to navigate that. But, when we look at Latin America at large, countries that tend to either be debtor nations or somewhat balanced in terms of assets and liabilities, they certainly benefit from a weaker dollar. And then we look at Africa, or we look at parts of Southeast Asia, these various, smaller developing or frontier markets, they certainly benefit potentially from, say, a 100 basis point cut in U.S. interest rates because they've been very much squeezed by the stronger dollar.
And those frontier market currencies, those currencies have been very weak against the dollar for the last year or two, right?
The vast majority of them, it's kind of idiosyncratic. I mean, if they have current account surpluses and positive real rates, they've held up reasonably well, whereas other ones have done poorly. Some of the ones that did poorly in bad crises, I mean, Brazil has held up pretty well. They have decent reserves relative to liabilities. We see that in South American countries as well. This is not really a repeat of the Asian financial crisis or the 1980s Latin American crisis. One way that we can characterize this is that every time the U.S. goes through the cycle, it gets stronger for the foreign side. So back in the 80s, the U.S. was a creditor nation. We owned more foreign assets than foreigners owned of our assets. And so when we strengthen the dollar, they have more dollar liabilities than they have assets. And so they get absolutely killed. And then we fast forward to the late 1990s. Overall, the world is stronger, but there are still very soft spots that have more liabilities than dollars. As we fast forward to the late 2010s or now in the 2020s, the world has way more assets, dollar-denominated assets, than they have liabilities. And there are still certain countries that have more liabilities than assets. The Turkeys of the world, or the Lebanons of the world, or the Egypts of the world, and mostly certain kind of what we call frontier markets. But when we look at the big BRICs nations, so China, India, Brazil, many of them are actually quite strong in terms of foreign assets relative to liabilities. And that's in large part because they spent years or decades running structural trade surpluses against the United States. The world reserve currency means that basically the rest of the world finances us, and we run structural trade deficits or current account deficits with the rest of the world. And there are smaller nations that don't handle that well or otherwise can't sustain that. But there are many mid-level nations that take that surplus and then they build reserves with it. And so we're in a situation that is, in my view, a lot more multipolar than it was in prior cycles.
And what you described just sounds a lot like Triffin's dilemma, but a lot of those countries that are running trade surpluses now, they've started to diversify reserves out of US treasuries and more into gold. But I think a lot of these developed countries, whether it's Japan, Korea, Canada, Australia, these countries have a lot more debt than they did in the past. So they've accumulated an enormous amount more debt. So their currencies have, I would say, been a lot more weaker against the dollar than they have in the past. We're starting to see a lot of these developed countries act more like emerging markets lately, especially like Japan and Korea with their currency weakness.
So those, yes. But I would separate there's developed markets, there's emerging markets, and there's frontier markets. The strength has been in the emerging markets. So, for example, the Brazils of the world have held up better than we might have otherwise expected from the Fed going from 0 to over 5% interest rates. I mean, there's a lot of countries that would have been crushed by that in the prior cycle that actually held up pretty good in this cycle. They raised rates ahead of the Fed. They raised rates to 10% or higher, and they were able to basically front run the problem. The problems have been more isolated. And in Japan, I mean, despite the currency devaluation, they have a positive current account surplus. They produce more than they consume, and therefore it doesn't impact people as severely as you would expect. It's not an outright crisis. It's more like a choice that they're going through as they optimize it. They have very high public debt levels, which restricts them from raising rates. But this is after a period of multiple decades of asset accumulation, basically running trade surpluses and current account surpluses, and so they own way more foreign assets than the foreigner sector owns of their assets. And so Japan and Korea have a number of levers they can pull, and you don't see any sort of disorderly breakdown or high consumer price inflation despite their currency devaluation. The way that I would characterize this cycle is that the big nations, like BRIC, so Brazil, Russia, India, China, their currencies actually held up pretty strong, right? The big emerging market currencies are fairly stable, despite some rather significant challenges. It's the frontier currencies, the Egypts of the world, the Nigerias of the world, the Ghanas of the world, the Argentinas of the world, the Lebanons of the world. These are the currencies that are breaking, but these, while it's terrible for the local populations, at a geopolitical level, these are marginal, right? So the biggest emerging market creditors are actually holding pretty strong against a stronger dollar. And, when the dollar eventually weakens, they're in a pretty strong position to come out of it strongly.
But the people on the street, so like the retail investor, I mean, the gold demand in Asia, so that's China, Japan, Korea, India, Thailand, Vietnam. I mean, it's soaring. The gold demand since October, we've just seen a lot of the gold demand statistics for the retail investor, institutional investors also picking up in Asia. Do you think that's because of the currency weakness, or do you think that's something else?
So it's a number of reasons. One, I think that, I mean, if you picture as American, what do we have to invest in? We have stocks, we have real estate, and we have hard assets like gold or Bitcoin, right? But if you're in another country, even other developed countries, let's say Europe or to some extent China or Japan or elsewhere, Europe's stock market has been flat in dollar terms for a couple decades now. Same for China, right? So it takes the stock market portion out. Japan's stock market's been decent ever since Abenomics. But basically, not many countries have the U.S. stock market that America has. And so in their markets, they either invest in real estate or the U.S. stock market, or they go into these alternatives, such as gold and Bitcoin. And obviously in the East, gold is a very big asset, both in China and India. And a number of central banks, given the U.S., freezing and confiscation of Russian reserves and the potential kind of breakout from that, have looked into having a scarce asset, gold that grows at a 1.5% annual growth rate compared to the U.S. dollar historical broad money supply growth rate of 7%. So that's a benefit, but then also the fact that they can just self-custody it, so nobody can confiscate it from them. That's the official reserve side, but then also from the private side, there's pretty significant demand from India, culturally, and then also China. If you're a Chinese investor, you're intelligent, you're educated, you're looking around, you see, okay, well, my real estate was overvalued and is now going through a long disinflationary cycle. The Chinese equity market has not been great, but Chinese banks do allow the purchase of gold, and in many cases even promote it, and it's a big cultural thing. So many of them buy gold, and so I think it's natural that we're seeing gold demand and to some extent Bitcoin demand around the world because not everybody in the world has the S&P 500 performance that Americans have grown accustomed to.
You also have a lot of Chinese bank failures, especially the small banks, and they've been bailed out. They were rolled up into larger banks. I think back in April was the largest amount of cash withdrawals in Chinese banking history. So there was just an enormous spike, and I think a lot of that cash it went into Mag 7 stocks here in the US. I think there was a closed-end fund that was 30% premium net asset value for Chinese investors to get access to Mag 7, but also physical gold. There was a huge and silver. There was a huge discrepancy. I think it was at one point for silver, it was almost $6 an ounce between the Shanghai Gold Exchange for physical silver and the prices for physical silver here in the US. So there was a large arbitrage potential.
Yeah, and I think that shows the demand for it. Whenever you have kind of a sustained price dislocation like that, that shows the demand. There are plenty of Chinese people that would be happy to own. For a long time, they noticed that their domestic real estate was overvalued, so they went and bought Australian real estate, Canadian real estate. It also helped them own assets in what they perceived, I think, rightly as a better rule of law jurisdiction than their local jurisdiction, or at least they diversify their jurisdictions in terms of rules of law and assets. So they would buy real estate elsewhere and prop up their real estate markets. That's, I think, kind of coming to an end. And one of the simpler things they can do is buy things like gold, buy things like Bitcoin, which is harder in China. Gold's more endorsed in China. Bitcoin's a little bit more complicated. But basically, they can buy monetary assets in a world where their stock's not doing very well, their real estate's not doing very well. Even the markets they externally invested in, like Canada and Australia, are not doing very well because a lot of that's malinvestment. When you have weak money, you buy non-monetary assets as your money, right? So when money is bad, either in terms of inflation or because you don't trust that it's not going to be like taken away from you, you go and buy assets. Either domestically, you buy real estate, or foreign, you buy real estate, or stock markets, things like that. But when you can trust your money, you buy the money instead, unless you have a very high conviction about investment. And what characterized the past decade is that many investors around the world, for understandable reasons, could not trust their money, and so they performed malinvestment into a variety of real estate assets, stock market assets, and so forth. And if anything, I think gold buying and Bitcoin buying is more of a return to normalcy. It's basically buying a monetary asset as optionality while you wait to see what you want to deploy that investment into in a non-monetary sense.
I think a lot of people are also are not trusting the official government inflation data. I mean, I hear this from my European listeners in Switzerland that the official inflation rate there's like 1.4%. They're telling me there's no way that it's 1.4%. So a lot of people are starting to hedge currency debasement risk, fiat currency risk, and it's all these governments. Really, since the pandemic in 2020, I mean, I don't know the exact number on the money supply creation, but it seems a lot of these governments and central banks decided to create enormous amounts of new currency units. And now you're starting to see that the central banks are in rate cutting mode, and what they want to let the real inflation rate run above the government bond yields is not just the U.S. policy plan. It seems like it's global.
So I think a big challenge that developed market central banks ran into is that in the prior cycle, they wanted to let inflation run hot relative to their yields, but it quickly became more unpopular faster than they expected it to, and so they were forced to raise interest rates. Whereas in a sustainable sense, they can't really maintain 100% debt to GDP ratios with ongoing deficits with positive real rates. And so I think that became a near term political thing for them to manage, even though it was unpopular in the long term sense. And so I think that's going to be a returning phenomenon in the years ahead, which is the balance between austerity, which helps control inflation, but feels bad for many people, versus letting inflation run hot, which feels good for some people, but feels bad for other people. Um, and this is a phenomenon that emerging markets go through on a regular basis, but the developed markets haven't really experienced since the 70s or before that, the 1940s.
And you've talked at length about the 1940s. And for our listeners out there, they can go and listen to prior interviews where Lyn and I discussed the 1940s and the 1970s. I want to get your thoughts on the yield curve uninverting the 2 and the 30. Do you think that this means that a recession is coming?
So I think that's a somewhat arbitrary mixture. Historically, when you look at recessions, the 3 month and 10 year yield curve is far more instructive and far more reliable than the other yield curves that are around. Um, I think it's inevitable that the yield curves have to inverge. It doesn't make sense for them to be structurally inverted indefinitely. Um, I'm also I am concerned about recession risk. So, for example, back in 2022, I was concerned about, early 2022, I was concerned about recession risk. But by the time we got to late 2022 or early 2023, I sort of realized that the fiscal side was outpacing the private side, that rate hikes were exacerbating fiscal deficits more than they were suppressing private sector lending. And so I became more bullish. Basically, that period was kind of peak bearishness among analysts. They were expecting, kind of unanimous recession, disinflation, whereas I pivoted to a more bullish side.
Is that
But
like post
now,
Silicon Valley? That's like after Silicon Valley Bank?
so I started leaning that way before Silicon Valley Bank. I mean, I had my famous like Oracle meme, where rate hikes potentially exacerbate deficits and inflation. That was before then, but I think Silicon Valley Bank really solidified that the collapse of that whole thing. The Fed's and the Fed and the Treasury saving the banking system over fighting inflation. That kind of solidified it. But you could see it building by, say, December 2022 up through March 2023, where it really got solidified. And I started kind of focusing on it in that kind of earlier period and kind of nailed it there. I think we're in kind of an opposite scenario now, which is that many market participants have concluded that recession is off the table. And yet, ironically, we're seeing the opposite signs. We are seeing unemployment rise from 3.4% to 4.1%. We're seeing an ongoing structural decline in temporary help services. PMIs continue to be weak. The U.S. Trade deficit is weakening because a strong dollar is not great for U.S. businesses and pretty good for foreign businesses. So I actually think in the next 12 to 18 months, we're at a higher risk of recession than we were a year or year and a half ago. The only caveat that I would give to that is that fiscal dominance recessions or emerging market recessions tend to look different than the recessions that we're used to. They're not necessarily as disinflationary. They don't necessarily have unemployment rates that spike to the same high levels. But instead, they potentially have higher inflation. So I'm not quite as bearish on unemployment levels, even though I expect them to go higher. But I'm less bearish on, say, a disinflationary collapse and more expecting of stagflationary type situation.
Yeah, I agree. I mean, if the US federal government, if they're projecting fiscal 2025 spending to be over $8 trillion, not counting interest payments on the national debt. But what we're seeing in the private sector, though, I mean, the consumer, the real economy, it looks bifurcated. A lot of consumers look tapped out unless they've benefited from higher home prices and their stock portfolios. So unless they own a lot of assets and they don't own a lot of variable interest rate debt, they look tapped out. And we're seeing this with the small business bankruptcies, a lot of I would call them middle class businesses, restaurants and retail. They're closing locations like crazy. They're doing strategic bankruptcy. So there's a lot of red flags there that the real economy is much different than government spending.
I agree with you. I would just flag that emerging markets often go through this. I mean, if you look at Egypt, their public sector, which is increasingly dominant, is doing fine because they control it, whereas the private sector is struggling. And the result is that, unemployment is pretty low, but inflation is pretty high, and most metrics of per capita development are suffering. The average Egyptian is using less energy than they were 5 or 7 years ago, which from a very low per capita energy base is a very bad thing, right? So that's an example of you can make it look like not a recession. You're like, look, everything's growing, but on a per capita, productivity basis, it's not good. And I think that's likely what we're going to see in the US, which is that the outright nominal disinflationary recession metrics, I think, are likely not going to be as deep as 2020 or 2008. And I think the unemployment spikes, as officially measured, are not going to be as high as those 2 decades or those 2 recessions either. But when combined with inflation and combined with real world effects, will still be quite potent. I think that's kind of what we're going through.
Yeah, input costs for a lot of small business owners in the surveys, the input costs are still rising, whether that's higher capital costs, higher energy costs, higher labor costs for a lot of different industries and businesses. Those costs are all still rising. So, I mean, that would add to the stagflationary environment thesis that you just talked about.
Yeah, I think that's what we're going through. And I think, there are a couple policy choices. I mean, if, the next couple quarters could still very well have disinflation in terms of CPI and things like that. But as we look out further, if they do enter more recessionary conditions and then they try to stimulate out of those conditions, that's when I would expect a second inflation wave to be pretty high risk in that scenario. I also think CPI has always been somewhat of a false target. So in the past couple decades, things like computers, electronics, plastic toys, they have outright deflated in prices thanks to, say, Chinese productivity and technological productivity. Whereas things like childcare, education, healthcare, and other services have gone up at a higher rate than CPI and housing prices. And those are in many ways more important to us. And yet the CPI can kind of mix those together and say, hey, look how low CPI is. And I think we could absolutely encounter that in the future, but potentially reversed. So in the world of AI productivity, we could have a scenario where services don't expand in prices much at all. I mean, maybe accounting services and other business services outright deflate because of AI productivity. Maybe one worker can do the work of 5 workers in a similar way that electronics and outsourcing did for the prior generation. And yet we could be in a situation where energy prices, housing prices, basically real world physical stuff, linemen climbing up and fixing transmission lines, people digging ditches for gas lines and electricity lines and things like that, people building houses, people building infrastructure. That kind of thing could be growing at 3, 4, 5, 6, 7% inflation, while some of that white collar stuff deflates thanks to productivity. So I wouldn't necessarily view inflation as one number, and instead I would focus on inflation being a spectrum. It's a number of different measures that are combined together. And I think that some of that is likely to reverse compared to what we've been accustomed to over the past decade or two.
Also, with the Cantelon effect, which I would argue is a form of corruption because economic and political elites are getting access to cheaper capital. I mean, the price levels, the distribution of all the currency and credit in the Cantelon effect, it's not evenly distributed. So certain prices will go up, certain prices will go down. If Nancy Pelosi gets the CHIPS Act funded, for example, I mean, 5 to 7 years from now, we're going to have a lot of semiconductors, a lot of semiconductor foundries online, and there's probably going to be an abundance and oversupply of semiconductors, and the prices will either stay at low, they will not go up that much, or they may fall a lot. There may be a huge bust.
Yeah, I agree with that. I do think that Nvidia and related companies are likely due to a down cycle. It doesn't mean that what they built isn't real or what they're being used for isn't real, but that it could mean that it's over expected or overdone, and that we could get a higher low in terms of their activity. That would be my base case. There was a period back in the 2000s dot-com bubble where the media companies like Yahoo were financing the startup companies, and you had this like circular loop where all sorts of activities being done without revenue. And you have a similar situation now where everybody expects AI to do well. So NVIDIA's built up, so then they're able to fund AI companies to then buy their own chips, right? And so while I do think a lot of this is real, I mean, I expect, 5 years from now, I expect on a per capita basis, we'll be using more GPU processing power than we are now. There are, 18-month periods of time where it can get greatly overdone and then go through a contraction and right sizing. And I do think that's a pretty significant risk.
Well, I actually wanted to ask you about big tech and the amount of capital expenditure that they have to invest, because this is not software as a service where, for example, Microsoft can just issue a new version of Microsoft Office, and it's not going to require, say, $150 billion of capital expenditure that Amazon is planning for next generation data centers to build it out. So these capital expenditures, I mean, they have to build out these data centers that require an enormous amount of materials, an enormous amount of parts and labor. They burn through semiconductors quickly. They burn through electricity. Do you think that this Capex cycle is much, much different than the past for big tech?
So I do think it's different. I think the past, call it 15 years, most of the tech growth we have has been software oriented. So if you imagine, for example, a lot of things you replace with a smartphone. You don't need a printer. You don't need a calendar. You don't need like a dozen other physical real world things because you have your smartphone. And so for whatever mild impact you have on the real world resources with, your smartphone and the infrastructure, you offset that with a reduction in real world resources elsewhere. And social media is not very computationally intensive. Running an account for someone and a little bit of storage and a little bit of bandwidth is not a big deal. This is a very low hardware, low energy transition. That was the past 15 years. When we look forward to the next 15 years, I do think it's the opposite. This is a lot more hardware focused. We're not replacing devices with smartphones anymore. We've already done that. Now we want to outsource a lot of our thinking to very energy intensive machines, which is hardware focused in terms of processors and energy consumption. And so I think this is a lot more hardware focused, a lot more energy focused. And I think the economics of that on average are a lot more inflationary. I think that particular industry is not very labor intensive. I mean, a lot of that is just, energy infrastructure and infrastructure, going on. But other areas are labor intensive. I mean, if you work in HVAC or plumbing or welding or you're a lineman, that's where there's labor intensity because everybody else went into, gender studies or business or, whatever the case may be, and they didn't go into, being a lineman on high transmission electricity lines. The whole meme was learn to code. Well, learn to code. it turns out that one really good software architect with a bunch of AI coders can do the work of a lot of coders. But we're still nowhere near a bunch of autonomous robots doing our, when we have an HVAC problem, coming out to our house and fixing our HVAC system or our electrical system or building our electrical lines. Robotics are a long-term thing, but especially in the real world, that's much harder to do. So I actually think that real world stuff tends to be inflationary, and the energy expenditure from those more energy intensive AI things tends to be inflationary.
Especially if politicians and bureaucrats are going to block permits or delay permits for long periods of time. I mean, in Latin America, a lot of copper mines, it looks like things are headed in the opposite direction for open pit copper mining in a lot of different countries. You have the supply was already falling, but now with elections in a lot of Latin American countries with large amounts of copper production, it looks like it's going to be very hard to get an open pit mining permit. So there's going to be supply problems. And yet here you just described that we're going to need more conventional energy and electricity. We're going to need more copper. We're going to need more raw materials to build out these data centers, because the current data centers we have now, like you said, they're mostly for like YouTube. They're mostly for Netflix. So they're for streaming and they're for social media and streaming. They're not for raw computing power. One of the CEOs for a data center company, I mean, he was talking about the difference in data centers. He was like, we're going to have to keep the existing data centers in major cities and metro areas for people for their internet usage, for YouTube and Netflix, those types of things that use a lot of bandwidth and latency, as he called it. But he said, like, the next generation data centers, they're going to use basically an order of magnitude more electricity. The capital expenditure required, Goldman Sachs, I think, just put out a report in the last week or so. They're estimating $1 trillion of Capex, Lyn, in the next 10 to 15 years that is going to need to be spent by big technology.
So I agree with you, but a lot of this is self-correcting, right? So as communities run into energy issues, and as these big trillion-dollar companies run into energy issues, they fix that. And I mean, part of that's why I'm bullish on energy and copper and things like that, because higher prices kind of correct themselves over multi-year long term. And so if you're a trillion-dollar or multi-trillion-dollar data center company, tech monopoly company, and you run into an AI data center energy shortage, you're willing to throw $1 billion to fix the problem. You're willing to throw $100 million at lobbying, which makes you one of the biggest lobbyists in the country, and then another $1 billion for like physically fixing the problem when you need to, so that you can ensure that your $1 trillion or $2 trillion business continues to grow. So I think that that's going to be fixed, because that becomes more and more of a political and economic reality. One of the complicating factors, and it's funny, I mean, we talked about Bitcoin in our prior interviews. Bitcoin mining has been in the news for a number of years as being so-called, environmentally damaging and taking up energy and so forth. But Bitcoin mining as a whole is actually quite benign in terms of how it impacts energy, because Bitcoin mining is ruthlessly competitive. Capex costs barely matter. Electricity pricing is almost everything. And so Bitcoin miners have to go either to remote areas where there's stranded energy, natural gas without being offset, for example, or solar and wind or hydro being produced and nobody's taking it, so it's being otherwise curtailed. They can go in and buy that for 2 cents a kilowatt, or they need to do power purchase agreements where they make use of the fact that Bitcoin miners need low bandwidth and low uptime. So they can go out and say, look, give me your lowest power cost that you can possibly give me, but I will be as flexible as any customer you can imagine, right? So I will shut off first whenever you have a brownout. I will sell power back to you whenever you need it, but give me the lowest cost, right? So that's how Bitcoin miners have operated, either stranded energy or flexible energy. Whereas AI is quite different. AI, for one point, it wants to be near it wants to be near population centers because it wants to be low bandwidth. I mean, like low latency. It wants to be high bandwidth and low latency. So basically, people want to use AI. They want it to be fast. They want it to work very quickly, which means they want it to be near them. Secondly, AI has much higher upfront capital costs for the processors, and then they're less electricity sensitive, and so they have much higher uptime requirements. They want to be up 24/7. Unlike Bitcoin miners that are, it doesn't matter if an individual Bitcoin miner is off because the overall Bitcoin network is still operating. And so every Bitcoin miner, all they care about is on a per hour basis, what is my electricity cost? Whereas AI, because it's way more Capex intensive and way more sensitive to how close they are to the consumers, they're way more uptime focused. And so the funny thing is everybody freaked out a few years ago about Bitcoin miners. And ironically, AI is everything they actually feared. AI does want to be in population centers. It does want to compete with residential energy and industrial energy because it wants to supply the people in those regions with the services they want. And so it forces those regions to be energy efficient. Whereas Bitcoin mining, if cities say, we don't want Bitcoin mining or, we didn't care about, efficient energy, it was fine because they could go to North Dakota or, Northwest Texas, or they could go to Ethiopia stranded, mining, like hydro mining. They could go to South America stranded hydro mining. They could go to Chinese stranded hydro mining. They could mine around the margins. Whereas AI energy consumers actually want to be in population centers with high uptime and low latency. So that's more in the face incentive to build energy and distribution infrastructure, which is energy intensive and in some cases commodity intensive, like copper.
But the current artificial intelligence, like their electricity usage, I wouldn't describe it as efficient at all. Didn't Google just announce in the last week or two that I think like they were planning on going net zero for carbon, but their electricity usage, just testing out their artificial intelligence algorithms, it spiked by over 50% in just the last couple of years. So I mean, obviously that sounds very inefficient to me. And the next generation data centers, I mean, we're talking tens of billions of dollars in capex per data center. Microsoft and OpenAI are planning by 2030, I think $100 billion 5 gigawatt data center. So these are not tiny projects. They don't sound efficient. It sounds like they're going to have to work out a lot of bugs. And then you have behind the scenes, the big technology companies, they're scrambling to secure additions to nuclear power plants or put the data center near an existing nuclear power plant that could be expanded.
Yeah, I mean, for example, Amazon agreed to acquire a nuclear power plant. I think that kind of thing is going to become more common. That was an outlier event that's going to become like a status quo. I think the data center companies are going to have to partner with or acquire energy businesses because if you're a data center and you want to move into an area to serve it, you need a reliable energy. And if you're an energy consumer in a given area and a data center wants to move into your area, you might like the AI that you're getting, but you hate the fact that your power might literally be disrupted. In a similar way that described, in Egypt, they had to ration power. They had to do rolling power outages from hour to hour in certain neighborhoods. So people are always going to prioritize not having power outages over having access to fast AI. And so in order to resolve that, contradiction, I think a lot of AI companies or data centers are going to have to be the master of their own domain in terms of managing power. And this is where narratives crumble, right? I mean, we've seen in recent years companies like Shell and BP, these energy companies that try to embrace so-called renewable energy, which is not as, in many cases, not as renewable as advertised. They've had to dial back their investments in those categories because they're being punished by the market finally for making those investments. And I think we're going to see a similar thing in AI demand, AI data centers, tech monopolies, where narratives only go so far. And once they run into actual frictions, these trillion-dollar companies are going to spend billions of dollars to fix their problem, which is bullish uranium, bullish, small nuclear reactors, bullish innovation, bullish hydrocarbons, and bullish fixing the problem, even though it goes through a period of friction.
Yeah, I agree. Here in the Northern Virginia area, we have probably more data centers already in existence and more being planned. I mean, Amazon, Microsoft, Google, and Meta are all buying up land. I think Amazon spent many billions of dollars buying up enormous acreages of land. They just announced that they're going to build a university-sized data center campus for next generation ones that's going to be constantly upgraded. They're spending billions of dollars. They have 100. I think they just spent in the first quarter. They spent 14 billion in capex solely on data centers. Almost all of it was for artificial intelligence. They're planning 150 billion of capex spend. Most of it's for data centers and artificial intelligence software upgrades. There's going to need to be a lot of natural gas pipelines. I mean, EQT, which is what in the Marcellus and Utica shale, for example, that's one state over. That's in Pennsylvania and West Virginia area. They're planning on building a pipeline down here to Northern Virginia towards the data centers. And then even the Washington Post, I think back in February, ran an extensive data center article. And the expert that was quoted in the article said the Northern Virginia area needs 2 more new nuclear power plants to handle all the data centers that are going to be added.
I agree, and that's the difference between, say, for example, AI energy usage and Bitcoin energy usage. And I come at this from an electrical engineering background, which is that AI needs the energy to be near the user and with high uptime, whereas Bitcoin mining does not need to be near the user and doesn't need high uptime, which is very different. And so, being near Washington, D.C., and the Northeast in general, you need a lot of AI data centers in that area near population centers, which do compete with residential and industrial usage. And so that's why I expect to see less politics and more lobbying and more, security of these energy contracts and build outs. We've already seen in the current administration, Biden has somewhat supported nuclear energy. He's even been somewhat supportive of hydrocarbon energy compared to what he campaigned on out of necessity. And what looks like the potential future administration, we look at the Trump-Vance administration, they're pro-nuclear. They're pro data center. They're pro all of this. I think
Bitcoin, they're pro Bitcoin too, right? They were the first.
Yeah, and so to take politics out of this, I think almost either way things break. The financial necessities, the economic necessities point toward being pro energy. And while Europe kind of commits seppuku over this whole thing. I think America, the way the politics are structured, the way things are structured, we're far more incentivized to actually build data centers, embrace new nuclear technologies, and go through with it.
So from an investment perspective in the long term to play this trend, do you think that maybe investing in utility companies, nuclear power, natural gas producers around the population areas, the pipeline companies, those types of infrastructure investments and energy inputs that produce cheaper baseload electricity would be smarter than investing in, say, a risky small cap technology company that's doing artificial intelligence investments to play that trend?
So I think so, unless you are super knowledgeable and high conviction about the niche that you're involved in. If you are super high, high conviction, specific AI or specific nuclear technology, then go for it. That's your field. Go for it. Invest in it. Have fun. If you're not a subject matter expert, I think the low-hanging fruit is that oil and gas in the U.S. are inexpensive, and the producers for them are inexpensive. Many of them have good balance sheets. Many of the pipeline companies are inexpensive with good balance sheets, and a lot of them locked in low fixed-rate debt, which is great given the fiscal situation we discussed earlier in this interview. and their ability to gradually raise prices. Um, I'm more mixed on utilities because they have a lot of capex costs, and a lot of them are fairly expensive. So I'm not super bullish on utilities per se, but basically anyone betting from uranium being more in demand, natural gas being more in demand, oil being more in demand, producers that are well sustained to produce them with fairly low cost and fixed rate debts. All of that is well positioned. So I'm broadly bullish on the energy complex, as well as to some extent more targeted on the infrastructure and distribution complex for those.
Do you think that copper is going to benefit from this data center and artificial intelligence trend?
So I do. I mean, part of it is the supply demand characteristic of copper, and part of it is electrification and AI. Um, it's a little bit harder to invest in copper miners from a producer side than energy producers from a producer side. But yeah, long term, if you ask me 5 or 10 years from now, will copper prices be higher than they are now? I would say probably yes. Um, and that's one of the most important materials in the future economy, kind of regardless of how this goes.
Did you see that Sprott is launching a physical copper trust? So they're going to have one similar to uranium. So we'll see if it succeeds or not. It's too early to tell. I think they just launched it in the last month or so. But some of their other physical metals trusts, whether it's uranium, platinum, and palladium, the gold and silver ones, those ones seem to be sound because I think an important thing here with all the inflation, the higher input costs, if you go back and look up charts, whether it's the gold price, silver price, versus the miners. I mean, the miners for the last 10 or 15 years, really since 2009, 10, they've drastically underperformed the metals price, whether that's copper or uranium or gold and silver. So the producers have drastically underperformed the rise in the actual commodity price.
So I agree with you. I think it depends on the characteristics of the commodity we're talking about. So for example, when it comes to gold, silver, or uranium, I would rather hold the underlying gold, silver, and uranium rather than the producers. When it comes to energy, oil and natural gas, hydrocarbons, let's say, I do like the producers. They tend to be low valuation, cash flow positive, strong balance sheet, and they make money even when oil chops sideways for a number of years. So I'm pretty particular based on the commodity. For me, copper is somewhere in the middle. And so overall, the fact that, I've been kind of torn between the fact that I'm bullish long term on copper. I don't love the producers, but I don't hate the producers either. But there's been no, clean way to own the underlying copper long term without thinking about it. I do like the fact that Sprott would build out a copper fund. Um, and I'm overall somewhere in the middle. So, oil and gas, I'm strongly on the producer side. Gold and uranium, I'm strongly on the commodity side. Copper, somewhere in the middle, and I'm glad that investors have options for how they want to deal with that.
And as we wrap up here, I want to get your thoughts on gold miners. So gold miners have drastically underperformed the metals price for a long time. There's been, I think, out of the many hundreds of different gold stocks, I think there's been 5 on the max charts that have actually are up a lot since 2010, and 3 out of the 5 of them are royalty companies. So that's like Franco-Nevada, which is still up over 5x since 2010. You have Wheaton Precious Metals, Royal Gold. The other 2 companies in that list are Agnico Eagle, which bought Kirkland Lake at the right time, and Lundin Gold. There might be a couple others in there, but the majority of gold companies have drastically underperformed the metals price. Do you think now that the gold price in US dollars has rallied enormously since March, it's up almost $500? It's up now over $500 now when we're recording this interview. Do you think that we're starting a bull market in the gold mining companies now?
So I think probably over the next few years, the answer is yes. When it comes to gold, my first priority is gold itself. My second priority is those royalty and streaming companies. And my third and much smaller allocation is the miners, which have not particularly paid off, as you pointed out. The challenge is that, gold miners, because I'm bullish on both gold and energy, gold is their revenue, energy is one of their key costs. Whereas royalty companies, they don't really care as much about costs, but they, of course, they deal with higher valuations in the meantime. Um, and so I've been less emphasizing of gold miners. One of the challenges is that, if you're a top 10% gold miner, if you're a Lundin, for example, you might do well. Whereas if you're a bottom 9%, 90% miner, you're more likely to underperform the thing you're mining. We see this in the Bitcoin space as well. It's a very competitive business. If you're a if you're a top 10% allocator, counter-cyclical, smartest person in the room, you're likely to do well. It's a field where winning is a highly correlated view toward winning in the future, right? So you want to bet on people that have won in the past and that they have a track record of maximizing shareholder value, because it's a counter-cyclical quality management business. So I'm not the best person to ask around mining. You certainly want to ask experts, but I would say don't enter the field unless you're pretty convicted about the space as a whole, or as long as you're willing to hold it as a small position and let it run. You definitely want to do your research company by company and know what you're getting into, because it's a very challenging business.
Well, I mean, the costs for gold mining are up enormously. I think back in 2020 and 2021, because of low energy prices and the Fed had not raised interest rates, cost of capital was low. I think a lot of the miners were producing below $1,200 an ounce, but now the costs have gone up enormously in the last like 3 or 4 years. I think like the cost for Newmont mining, they were around $1,100 an ounce and they hit 1,500 recently or right around there. Although Newmont's claiming, I think by 2028, I honestly don't believe them based on all the difficulties of the industry. They're claiming by 2028 their cost will be below 1,200 again.
Yeah, I think that's the challenge of the space as a whole, that basically with debasement, gold goes up, but also energy goes up. So I'd be, ironically, I would certainly be more interested in your opinion than my opinion, because I know you pay attention more toward individual miners in the mining sector as a whole than I do. So I guess for the benefit of the audience, what is your view of the miners and the royalty companies as a whole right now?
I think they're in a decent window for now. I mean, it depends on which mine, where the mine is located, because unfortunately, it looks like in Latin America, a lot of open pit mining, things are headed in the wrong direction, I would say. So in terms of supply, there's going to be a restriction on supply for copper and silver. It looks like a lot of permitting and for new mines going forward is either going to be delayed out for years or denied outright for open pit mining. And then we're seeing these accidents with the heap leach pads, either in Turkey and then the one in Canada with Victoria Gold. That could mean that the permitting process is delayed out further. So if you already have a mine and in production, that would be good. But if you're trying to bring a new mine into permitting and stuff, that could be delayed out longer.
Yeah, which is good for the holdings of the existing metals, right? So, one of
Restrict
the things
supply.
that
Yeah. Yeah.
yeah, and one of the things I've been emphasizing is a three-pillar portfolio, right? So the classic example is 60/40, stocks and bonds, which is entirely, prefers disinflation. Whereas I've been emphasizing the three-pillar portfolio, which is one pillar is, long-term growth-oriented stocks, which prefer disinflationary growth, and then various either cash equivalents or tips, whatever an investor wants to do in order to minimize volatility, and then hard assets. So things like gold, Bitcoin, uranium, infrastructure, energy producers, that kind of thing. Um, and as I described before, when it comes to gold or uranium, I tend to prefer the commodity itself, whereas energy, like oil and gas, I tend to prefer the producer. Bitcoin, again, I tend to prefer the producer, even though I'm on the board of a pretty large mining company. But you have to be a specialist in order to get the mining right. And so it depends on the commodity if you're going to the commodity side or the producer side. Overall, I think copper is somewhere in the middle. But for me, yeah, basically gold, uranium, and Bitcoin are pretty firmly on the just own the commodity, whereas oil and gas and some others are more interesting for the kind of the structural, oligopolist producers.
Yeah, so for years now, I've actually been looking for gold and silver exposure without actually owning the mining company. So, like, you can do that through owning metal. You can do that through owning royalty companies. You can do that through owning Sprott Inc., the parent company, which has the metals, all the different metals trust, the uranium trust. We'll see how successful the physical copper trust is. And then Cuppy just wrote an article about the bullion, the refiner, what AMark. So he's trying to get access to metal without actually owning the gold mining stocks because over the long term, what they just have what their costs rise, they can't maintain free cash flow, they have profit margin issues. If what the gold price goes to 3,000, 4,000, 5,000, then the governments in some of these emerging market countries are going to be like, oh, we want to renegotiate the royalty tax.
Yeah, no, I fully agree with you. I think that's a whole complication to deal with. I've generally been on the side of the royalty companies more so than the miners, but even the royalty companies are not immune to the various restructuring and complications that you see in the mining industry.
Oh yeah, I mean, like there's specific case examples. There was like a 6 month window about 6 or 7 years ago for Royal Gold where they restructured a gold stream and the shares crashed, but that was a buying opportunity. I mean, if you bought Royal Gold shares back then, you more than tripled your money, I think, since like 2016 or 2017. That was when they restructured the Mount Milligan gold stream. And then Franco Nevada was weak, the shares, because of the Cobre Panama deal. Those shares were 110. I think they got down to 110. Let me look. I haven't looked at the stock in a. It's back up to 131. So, I mean, that was what, 9 months ago? The shares were down, stuck around 110, and you're already back up to $131 a share in Franco Nevada. If you bought around $110 a share, you've already gotten a decent return.
Yeah, sounds good.
Well, Lynn, I really enjoyed our discussion today. Please tell my listeners more about your book that's been out for almost a year now and your newsletter.
So people can check out Broken Money. It's a bestseller on the history of money and the past, present, and future of money and monetary technology, and where we're probably headed, or how to think about money as a whole as we go through pretty challenging circumstances. People can see my work on lynalden.com, all my various research work, and I'm also available on social media on Twitter or on Noster, so people can see it there.